live on YouTube. Here we are. Welcome all of our YouTube friends. It's that time of the day on Thursday when we transition from our group coaching, which we would love for you to all come experience sometime, to our general coaching. Let me get my audio muted here because I'm hearing myself talk back, and that's just weird. Today's outcome, we're going to take a look at the overall market real quickly here before the Fed starts speaking at the IWM, or not IWM, IMF. I have too many acronyms that run through my head, y'all. And, the big thing to note is that obviously the market is indecisive here. So we gapped up this morning. We've traded on back down. Where we go from here, nobody knows. It could end the day with a candlestick that looks like this. It could end the day with a candlestick that looks like this. And so it's going to be kind of fun. We'll watch that happen here in nearly real time as we're in this session. Of course, I'm joined by the one, the only, as he's now referred to as Stock Landers. Can you all give Stock Landers a round of applause? Yay. I had a misspeak in one of our live trainings this week, and it just slipped out, Stock Landers. And I'm like, yes, that is now his trading persona. So we'll come up with a nickname for me as well. But
sorties, do your thing.
Yeah, no. Oh me. And Chris Burgess, I want to give him a shout out as well. He's moving this week from Miami to Colorado, and he's also participating in some family activities. He's got a sister that's graduating with her master's degree. So we're celebrating her and supporting Chris as he is spending time with family. But he'll be back with us next week for the show. It's always good to have both Chris and Scott here. So anyway, I don't have a lot more to share. There's going to be a market update coming out soon. I say soon. I just recorded it, and then I realized that TradingView was giving me an inaccurate candle on the Dow. And that's embarrassing. So unfortunately, my whole afternoon schedule is booked, and I'm the one recording the market update this week because Chris is traveling. So we'll see if we can get that out. But, I'll tell you guys here in the show, in case I don't get that out until tomorrow, the market is very neutral. That was the punchline that we came away with, the market update. It's very neutral. It's very indecisive. I don't know if it's going to go lower or higher. And you need to design your trading strategy around that uncertainty. And there's ways that we can do that. The easiest way to do that, which is what I shared in the market update, which probably won't get published at this point. The stocks that are trending bullish, trade them bullish. The stocks that are trending bearish, trade them bearish. And hopefully the outcome is the ones that are going up, go up, and the ones that are going down, go down. But if we get the market that craters, it may pull some of your bullish stocks down, but hopefully your bearish stocks go down even further and they outrun your bearish stocks. It's a way to balance and hedge your portfolio. And so I encourage you to look at it from that perspective. There's also sideways moving strategies you could get into. I don't know that I would enter a lot of sideways strategies long-term, maybe short-term weekly options that you're trading spreads on are okay. But do keep in mind, we're talking about this in group coaching as well. The adage, sell in May and go away, is there because it's a thing. Like for years, people have learned that May tends to be sideways at best or bearish. And of course, if we go back even 1 year, you see last May, what did we do? Sell in May, go away. 2020 was a little bit different because we just had come out of the COVID bottom. But prior to that, go do your research. You'll see that oftentimes sell in May, go away is a thing. So anyway, with that said, welcome, Scott. I'm glad you're here.
Thank you.
Do you want to lead us off with the first chart? If you have any chart requests, either live on YouTube or here in Zoom, you want us to analyze the stock and give a perspective on it, we're happy to do that. These are here to support you. But while those requests come in, Scott, I'm going to stop sharing mine. And why don't you give us some of your genius?
Absolutely.
I'm going to buy Scott a light. Wouldn't y'all like to see Scott lit up?
I actually looked for one the other day and I wasn't happy with the one I found. So I was just like, can't use that one.
Oh, I got links. I'll send you links.
Do.
You just want to see your face. Not be like the anonymous stock analyst. That could be a thing though.
Ooh, it could be. Your
But you're
brilliance amazes me. Always does the stuff you come up
you're
with.
you're stock landers. You got to stay stock landers. So
All
maybe I'll be
right.
the anonymous analyst.
This is one I showed yesterday in the traction group, and I pre-frame everything I do. Can't stress this hard enough. You need a pre-frame. And the reason for doing that, regardless of what you use, what indicators, you just need to have a concept of what you're trying to do. So this one was set up. You can kind of get a sense of how this is all marked up. These lines have been dubbed Pink Panther, thanks to Raymond. And they're really solid support resistance. This is all forecast. None of this is all off of just a couple points on the chart, but I want everybody to see kind of where apples behave today and reverse back over. I tend to focus when things are doing this on wave counts. So I'm going to shift from this chart and I'm going to go to currently where we are with the broader market. Just show you something. So by now, you guys know how much I like HCC, LCC, the higher candle close, lower candle close concepts. It's just a 5-minute chart and wave counts. If I start looking at this from kind of the top, if you just the most basic idea of a wave, well, this is kind of like the first wave, second wave, there's a third, there's a fourth, and this is probably a fifth wave down. We've probably moved, I don't know what the S&P's typical ATR in a day is, but I would be willing to bet we've probably moved it about now. We are coming into, his speech that's about, or it's already probably started. This kind of drop like this, as I was alluding to earlier, I see people go, oh my gosh, the world's coming to end, and now they want to get short. You're late. And with this slope, this will not maintain. And the frustrating part for me is my phone has been blowing up since we started this, an hour ago or so, from certain fund managers right now and telling me this and this and this. And I'm just like, you don't understand. That slope's not sustainable. And this is an important thing. What this stock's already doing, or this particular ETF, is already trading left of itself. It's already trying to walk down at such a steep angle. Okay. And every time it does this, you'll notice as it gets to the next level, it'll start to ricochet out. It'll bump off. It'll bump off. This is literally running down. It's not 90 degrees, but it won't maintain. Retail traders, even some pros I've known over the years, they see this and they're so busy looking at the right-hand edge of the screen where your price is, or you're looking at your P&L tabs on your platform, and you're so focused on the damage that's going on in the account, you're not looking for the opportunity that's going to present. Josh loves fibs. I like fibs, right? You're going to get a fib retrace out of this. Does that make me a bull? No. But if you're trying to build a batting average, which is what we're really trying to get you guys to learn to do, is to look at high probability, low risk entries, because you remember this. Your biggest concern in trading is the risk you're taking in the trade. How much risk are you putting on? Everything else you can't control, but you can control how much money you're going to risk. And Josh does a brilliant job of bringing this up. So if you have a market that's dislocating, which is what you have right now, and it's stretching over a band, how many deviations do you think it's moved? Well, it's just engulfed all of yesterday's range on the S&P. That's not hard to see right here. There's 420, now we're kind of moving back in this over here. We're trying to chew into these supports through over here, right? So let me go to, say, a little bit longer term. Okay. It's not hard to look left at this and figure out this is not sustainable. I mean, what is it going to do, guys? Is it going to, I want to challenge right in this really quick, because it's super important. Because even I've done traction for a year now with you, with through TSU. And I've shown so many times we have dislocations, and all of a sudden the dislocation's over with, and everybody they like, I can't believe I missed it. You can't let that spook you. And you're like, well, I'm not short, Scott, I'm long. Well, where was your stop? I mean, Josh was joking earlier about using stops and not obeying stops. I know we're joking with that, but that's when you have stop loss. And if we knew we had a Fed we have a Fed speaker, Powell, today, you need to understand the market might be nervous about what he's going to say. So you can anticipate this. This is why you should at least look at, if you have a little phone app, and I'll wrap this up pretty quickly here. If you have a little phone app like CNBC has one that tells you, hey, Jerome Powell will be speaking on this today. bells and whistles go off in your head. And much of that stuff is published when he's going to be speaking. Well, if you know that and the market gaps up kind of extreme, well, do you think it's going to keep going? Well, if you look left, price has what?
Memory.
Where's it stalling out? Now look at a basic trend line of this. And I'm not just in hindsight. So I do this all the time, guys. It's exactly how people do it. Well, if you know you're kind of running back over in this direction, like kind of extreme gap, and you look left, well, you're kind of fighting the slope of everything now. So let it pull back. Let's see if it can find another place to base from. And you can look left and you can see places where this thing has stalled in the past. But that slope's not sustainable. It's not. Everybody who's been me through traction, if you ask them, can tell you this, at least in the past year. It's been not the current group. But I want to show us one thing with this. And then we can shift gears to where you want to look at. See this drop right here? That drop right here. This is trying to go 90 degrees down. It can't maintain that, and your indicators are not going to tell you that. Your moving average is not. I teach a concept called inversion. It might help. But when these markets really dislocate, and Josh drew this out earlier with, was it Tesla? Whichever one we're talking about the flag pattern on. When they run up on a screen, let me just see if I can do this a different way. When you're starting to run up at a decent slope and they go 9 degrees against that, guys, that's not sustainable. They'll bounce out of that and then they can walk over. But you're not, that first hard 9-degree drop, you should be more, it's used the term aggressive as a buy-sell device, but you should not be fearful. You should be opportunistic. And I see this, I've demonstrated this through traction, and I point that out because I've demonstrated in the real time, not hypothetical, not in hindsight. And I see it the hedge funds like today. Oh man, it's going to do this. Look, dude, it's not sustainable. It's not sustainable. You will not find an example of sustainable. If you don't believe me, go challenge yourself. Better yet, go back and look at GameStop, right? GameStop, right? Back in the day, 3 or 4 days, how many hundreds of points up, and then it collapses. The same thing's happening here. And now it's going to have to work itself to the right. This is such an important point. I don't see anybody in the industry that talks about this like me, and I don't mean that to brag about myself. I drive the point home of time and slope. And you're living through this in real time with us, YouTube or through everybody else at TSU who's watching us. And I'm trying to tell you, it won't last. Now, if you did a basic wave structure, it's basically moved probably 5 waves down. That's opportunistic if you're a short-term trader. Now pretend you're an investor or swing trader. That same thing happened in 07, 09 in .com. It happened during the, one more thing, the pandemic, back over where it was, back over in here, when we've completely fell apart on the S&P. And so you see these opportunities show up, right? And then people don't take advantage of it. And I think that's what worries me, is that's not sustainable. And if you get into time, which we're not going to have time to do today, but if we talk about that drop in time, you'll understand why the big boys came in and bought that. And we can go through that at some point in time. I just can't stress slope hard enough. You spend the next year on slope, you'll be amazed. When we've done slope analysis with the algorithms, it always, always, always has improved performance. And most traders don't know how to bring it into that. And I'm not here to get that degree, but I just can't stress this hard enough. It drives me nuts if you can't tell, because that creates so much opportunity. The rubber band is stretched and everybody's scared to death. Why? Its stocks go up, down to the right. If it's super stretched, this is when you should be more opportunistic. I don't want to say greedy or aggressive, but opportunistic. I can't stress this hard enough. And I've demonstrated so many times, and everybody's like, ooh, hot stove, I can't touch the hot stove. I'm like, this is a gift. The algorithms are absolutely heat seeking this right now. That's the beauty of it. But most retail's like, oh my gosh, this is scary. What do I do? Oh, you shrink in. No, chest out, shoulders back. Have a plan. This is a gift. I forgive me for rambling through this or ranting on it, but it's really important, because these right here, I lived through the May 2010 flash crash when Apple gave up whatever it was, 50 points in like 90 minutes when they were riding in Europe. And everybody's freaking out. I was live just like this. There were about, 60, 70 people covering it live. And it's like, this won't last. This won't last. It won't last. It never does. And then people, and then it goes back to highs. Okay, it's safe to get in now. Well, you just missed a huge move. Josh, feel free to chime in. I just, if people have questions, just please ask. But this is this is so critical. And this is where I see most retail really gets hurt. They don't comfortably understand it. And if you're short this, if you need to be bringing your stops down and not just you're being given a gift right now today. Does that help anybody? Does that make sense? Or am I just losing everybody on that?
Makes total sense. I'll dovetail this piece into, and I don't want to just repeat everything we talked about in group coaching because that negates the need for group coaching. How do I get control of the screen again? There we go. But I think this is an interesting piece to look at as well. Before everybody freaks the heck out over, the big decline today, we were talking about this ticker symbol RSP, and this is, you can read on the screen, it's an equal weighting of the S&P 500. So y'all realize the ticker symbol SPY or SPX index is a market capitalization weighting. And so you've got 5 stocks that basically, FAANG, Facebook, Amazon, Apple, Netflix, Google. It's called the FANG or FANG M, or sometimes you see it FANG Plus, or there's a lot of different creative ways people write it. And that, if you'll overlay the FANG M stocks on top of the S&P 500, you'll see that as they go, so goes the S&P 500. So it's, yes, the S&P is a broad look at the overall market, but is it? And the sword cuts 2 ways. If these get bullish, then it pulls the market bullish. If they get bearish, it pull the market bearish. And what's interesting is if you just take an equal weighting of all the top 500 stocks or the S&P 500 stocks, we've really just gone nowhere for a year here. It's not been, the dramatic swings that we've seen on the S&P. So, where's this thing cratering back to? I don't know, maybe down here to 155 or so on RSP. I would definitely look at 150 as a pit stop, possibly all the way down as far as 146. But, until we started breaking some of these major levels down here, I would not freak out. And I would instead start using this as an opportunity to buy the dip. And to that point, if we came into an S&P 30-minute, so look at this. TradingView is malfunctioning. This is not a good plug for them. I have no ownership. There it is. It's back. I don't know if you noticed, all my template hotkeys were gone up here, and I was having that trouble earlier. And they've changed. Yeah, so it's malfunctioning. I don't know if they're doing some updates or whatever, but let me see. What am I looking for? Bollinger Bands. We'll see if this works. Even with today's volatility, y'all, look, we're not even outside of the Bollinger Bands. And what I was going to bring up is, when we get those environments where we get outside the Bollinger Bands, those are slingshots. We're just talking to Burgess about slingshots, opportunities to buy into this thing. And I think that's what Scott is trying to articulate to you guys. Don't necessarily freak out. Don't also go buy blindly. I mean, that's equally foolish, because where are we at here? Some of y'all didn't trade through this, and I'm not saying this is that. You know where I'm going, don't you, Scott? Mm-hmm. This can happen too. We just start trading on down, but this is not current events right now. And don't let the news media try to convince you that. We had so many warning signals and there was so much money to be made on this downside. But we're just not there yet. And even see, Scott, all y'all came and started buying SPY, and it's already started back up.
So, hang on, before I don't move from that chart, Josh. This is a really good point, though, that I want to tap onto for a second. Look at the middle of the Bollinger Band and look at the price reaction to it. Now, this is a subtle thing that a lot of people seem to miss. So, Josh, will you go take the cursor back to January of this year? Just walk over right there. All right, now come down to the very bottom of that Bollinger, right below it, right there. Stop. Now, see where it bounces back up to the Bollinger? The midpoint, the midpoint. Yeah. All right. Now, look at the moving average slope at that point. So it goes one deviation full across, comes up there, as the price is coming to the moving average of it, it's trying to bend over a little bit. So it's finding resistance, which would also be about the middle of a fib retrace at the same time, guys. What's going on currently? Now take that same ideology and now come to the current and look at what just happened and where we find that. Doesn't mean it has to roll over and die a fiery death, but you're at an inflection point in the market, which is what Josh has been saying, for now 3 weeks, probably, with his analysis. You're in the middle of this, you're in some sort of range. So think of it more neutral. Okay. But you can look for these slight subtle cues. And if you go look at really strong trending periods, if we go back over to say August, September of last year, Josh, for a second, see how it rolls down to the bottom of the Bollinger, all the way down. And when it came back to the midpoint, those moving averages have barely even blipped. Right? They've barely. And so that's a way of seeing, really buying a strong dip in the trend versus where you get to a potential inflection. Okay. And that one graph right there, if you're new to trading, take a screenshot of this, go look at it, look at how history tends to play out. They're leaving subtle hints. Okay. Remember, it's not a one-day event as a trend. It's a multi-day event. And that's where traders get lost. And so this chart is absolutely perfect. And of course, you can use what's in the bottom of the chart as well. Other indicators where you want to bring into it, the RSIs, whatever else you have. But it's that subtlety right there is such a big deal. Just a mental speed bump in your own head. Anyway, I hope that helps.
So this indicator on the bottom, for those that are unfamiliar with it, it's the relationship between price and the bands. So let's find an easy example right here. So the magenta line is on this dotted line up here. That's that moment in time where price closed right on the band. Same thing if we came down here, it's below this dotted line. That's when price closed below the band. So you can actually transpose everything Scott just told you guys. There's a 50, I don't know if you can see it on your end, but there's a very faint line that goes right through that 50%, which is where that 20 simple moving average is. So, here we go. This is what Scott was telling you guys. It came up, it touched that band, and then it continued on down. Bingo. And what are we doing now? Come up, touch the band. Now this candlestick hasn't closed at the band, so it looks a little bit different. You can see obviously more detail up here, but this, I put this on here because it makes for some really good searchability. If you're, to see how the price is in relationship to those Bollingers. That's very interesting. I didn't notice this until you pointed it out, but you're right. I mean, this is the same pattern.
Yep.
Very good.
This is the type of stuff I have to do for the funds. I mean, this is a simple example of that, but it's the slight nuances, especially when they're trying to trigger certain levels, certain things, and put on really larger positions. And they're looking for that little bitty, whatever it might be, to give a little bit more edge or to build a little better position, a little better pricing, things like that. It's just these subtle things will show up over time. And for a lot of you, it will help give you a little bit more of an edge or maybe a little more confidence when you're taking your trade. So I hope that helps.
Great. What stocks do you guys want us to look at? I haven't been keeping up with the Zoom chat. I've been watching Facebook. Good to see Rich here. I don't know if he's still here. Yeah, no stocks. Any stocks you guys want to look at? Or Scott, did you have any in particular that you wanted to bring?
Oh, yeah, I do want to bring up one. I'll show that I want to bring up, and it's not going to be the S&P, even though you can see where it's trying to hold right now. I want to go to NVIDIA. I mentioned this one to the group.
Guessed that. Should have guessed it. Turns out when they actually do their reporting, and Scott's going to be the only one that's been trading NVIDIA this whole time. He's like a multi-quadrillionaire, and he's the one that's moved NVIDIA.
So this has been stuck in like a range. And that's not hard to see right here. It's not just with this. Hang on one second. Let's make background dragging go away. It's not just with the 120 minute. It's with the 180. It's all been just consolidated down nicely. The 180, the 120, even the 240. You're like, well, of course it's the same. That's not always the truth. And so I posted this morning in the Slack channel, all that, and just saying, look, and as it, you see it kind of run up this morning and then fail, and you'll have momentum going in this direction. And you can see obvious key lows looking left over here, and you realize you're challenging that. And now you've got a weak market. And so one of the students there has already posted a chart, it's already had a full ATR, but it's breaking down. That doesn't mean it has to continue this way, but this is where opportunities come from. Guys, if you just look, and I try to get traders to do this, most won't go through the painstaking process of doing this, even though it's not that painstaking. Go take the S&P 500 list. If depending on who your platform is, like I have TradeStation, they have a radar screen. I can put the S&P 500, and literally as fast as I can hit the button just to click through it and just go through the daily chart or any time frame, and just it'll take you less than 5 minutes to go through them. You're like, Scott, why would you do that? Because if you do that every day, once a day, 5 days, 7 days a week for a year, it'll blow your mind at where you'll see opportunities just by training the brain. It's like, ooh, that looks interesting. And you'll pick them up without having to go out and do the scanning and all that. This is more of a training exercise. And a lot of traders won't do it and say, how did you learn all this stuff? How did you figure this out? Well, I've been fortunate with the people I've worked with over the years, but a lot of it was just grinding it out, looking at lots of charts, understanding the patterns that play out over and over and over again. And so you can do this. So I posted this this morning in the Slack room, and now it's breaking down. It's giving a nice little trade down where you want to do with it, but the opportunities will be there. But you have to put in the time, or you have to pay somebody to have a scanner like, Sky or something like that to sit there and say, hey, look here, right? But if you're trying to train your brain, put the NASDAQ 100 there, the Dow 30, and just go through it. You'll find it doesn't take any time, but you'll see these things developing, and it will help reinforce what you're learning as you progress. So that's the reason I bring this up, is just to show you guys a sample of what's possible just by scanning. I do want to go to Goldman for just a minute. If you guys have questions, just ask. I haven't looked to see. So Goldman, can we bring this up? Yeah. So this is what I was looking at for it to roll backwards today. And this goes back to like bullish and bearish. I'm going to bring this up for just a second. Come on, TradeStation.
Your charts are so much cooler than mine.
So you can see by looking left historically, you can see where Goldman is running into trouble here. And this is just a basic set of moving averages on here, just to give people context. That's what you're used to looking at. You can kind of see where she's struggling, both looking at something that has slope, like a moving average, a bendable moving average, and then looking left at where the things had resistance in the past. Again, price has memory. What was once support should turn into what? Future resistance. That creates opportunities. The stock has just had a really nice run up. But this goes back to, is it bullish, bearish, or neutral? Well, this is clearly bullish. You can see by the bright green. The dark reddish green right here, that's neutral. And this is bearish. That doesn't mean I blindly go buy the stock and short it. That's not the intentions behind that. It is give you context, because what I've witnessed over the years is this is an old school way of Wall Street saying how they look at markets as bullish, neutral, or bearish. And I know that Goldman, Morgan, and JPM are all on this exact same boat right now. They all have the same look, the same feel. So if it was the reverse of that and it was super bullish right now, well, then I might want to be considering only buying dips. Here, I might be considering shorting the rips. Does that mean it's going to stay bearish? No, it doesn't. But your most basic moving average, your 5,200 SMAs, are trying to tell you they've crossed over. And yet I'll watch people keep trying to buy these and buy these and buy these. Meanwhile, you've had stocks that look like this. And this is to give you guys a comparison. NRGU, I've put in front of different people I've worked with for the past, year or so. Brown, I guess, around 250, 235, somewhere in there, and it's now gone to 500. That's not to impress y'all. I don't want you to think that. But clearly, the stock has a more bullish feel to it. You compare this to the S&P, just to give you a difference between where the money is. Financials are weak. You got a strong dollar. Josh has pointed that out. And
that was in group coaching. I don't know if we mentioned that on the show here.
Oh, sorry. Yeah, in group coaching, he brought this up earlier. Now the S&P is where? It's in a neutral phase. It's also hit what today? It's 200-day what? SMA, right? So you can see where it's struggling here between its 50 and 200. So it's like a little band, ding, 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 or ping pong ball, back and forth, it's stuck there. But if you go back and look left in history back over here, you can see where you're running up, you're pulling back, but yet people want to be aggressive through here, like they should be bullish or bearish, so to speak. And Wall Street's telling you it's in a neutral phase. It's actually between its 50 and 200 that have kind of crisscrossed over. Even that's telling you it's neutral. But everybody wants to keep acting like we were a year ago in swing trade and keep buying the dip. And the market's trying to say, we're telling you to be cautious right now. Don't be over aggressive. So if the market gives you a good rip, take the rip it gives you. This is a mindset. That's why I came in the teaching in January, telling everybody in Traction, I said, guys, it's a trading year. It's not a trend year. And the market tells you that if you just take the time, 40,000 foot view to look at it first. Anyway, does that help?
Yeah, it's amazing. I'm curious. I mean, I know you can't get into all the details here, but is it the moving averages that are influencing the candle colors here?
No,
or
it has nothing to do with moving averages or anything like that. This is a completely different an alignment.
That's Scott's nice way of saying me this is a very expensive algorithm that he's not going to share.
So, and the reason I put the moving average on here is another way to filter what most people are taught. When we talk about bullish and bearish, this is the old school way that you won't find out there of how Wall Street has actually done this for generations, that you just won't find out there anymore. And we're all taught it's a certain percentage correction. Well, the funny thing is, if I were to take that same logic of what most people have been taught is a death cross, bull, golden cross, whatever it is, Goldman Sachs is not only 20% off the ties recently, it's also got the 50 below the 200. Well, not only that, then I've got the old school way of doing it. So now I have three things confirming. Does that make me perma-bear Goldman? It's not, that's not my mindset. Maybe they do bail this thing out down the road and they shift it. But right now it's nowhere in that condition. And since it's not, and they just had earnings, okay, well, what do you want to do now, Scott? Well, is there opportunity? If I want to find, and Josh brought some group coaching earlier, right? If you want to find a long, and I say this just like Josh does, if you want to find a bullish opportunity, going higher, then go find the chart that shows you that. Quit trying to be the hero and buy the dip and, thinking if you want a bear stock, if you want something to think it's going lower, then let's find that. If you want something that's bullish, then let's scan for that and find something that should be going higher, like the energy sector's been. And that's where I get it. People are trying to make trades be something like they're going to be the hero. If you want to do that as an investor and you have a long-term horizon, great. Most of you are probably more swing position, more active. Don't get stuck at 40,000 foot. It's going to hurt you. Look at the swings, look at the short-term oscillations, be more opportunistic, and keep this for the much longer-term macro and wait for the trades to come to you. And a lot of traders won't do it. And that's frustrating because you're missing opportunities because your 40,000 foot view is so far away. It has no value. It really doesn't serve you to be able to go trade in the near term. So I stress this because these are the things I constantly see traders struggle with and trying to do macro to micro analysis in trading. They're about something on a 200 moving average that's nowhere close to your price. And it's like we're at the third traffic light. You're not to it yet.
Sorties, I see your question in Zoom. What percentages are you talking about in the options chain? I can answer that question. I don't know what platform you're using or what percentage it's talking about. One thing I want to do, though, is riff on Scott's Goldman Sachs here. I'm not fancy and have all his algorithms that he has because he's a genius, but I can look at the past and get an idea of what the future is going to do. And this is a 100 and 200 simple moving average. And I don't necessarily watch these for crosses. I use them as quick ways to identify trends. Briefly, if the 100 is below the 200, you're bearish. And if it's above the 200, you're bullish. And if they're just crossing all over the place, it's sideways, which is where Goldman went from 2017 to 2019. But I think that it's interesting. If you look, I just pulled up this simple measurement tool. Here's where Goldman crossed over, and it was like that for 225 bars, 328 days out of the month, almost an entire year after that crossover. Let me clear the screen here so we can see a little closer. Then it went sideways, and I get you don't know sideways until hindsight. So, maybe we're sideways here, maybe we're not. Another thing you can do though is say, what does this look like? Does it look more like this here, or does it look like this sideways pullback there? So, ignoring the sideways move, which you wouldn't have seen until hindsight, here is another moving average cross. This one was 382 days, 261 trading days. It was over a year that those averages trended bearish. Let's do this last one here. It rolled. Oh, that was the COVID crash. That's not super helpful. But, if we were to project this out into the future and say, let's just come up shy of the year, it would be looking at about there where that red box is. So we're looking at November 2017, not 2017. Don't we all wish we're back in 2017? November of this year, 2022, before we start getting that moving average cross back up. So, this is the Titanic turning. This is not the little speedboat that's turning here. And, we were talking about chart patterns and group coaching. Hello, triple top anybody? Like, take a screenshot and put it in a technical analysis book, put it in Wikipedia, make sure you give credit to Josh Hesse as the source. Because we all know Wikipedia is the source. So I think we were talking, early in here more extensively in group coaching, but you're looking for trades that are going up, trades that are going down. This could be an interesting trade that's going down, and you're catching it on a retracement day. Could be an interesting opportunity for you. Goldman Sachs.
And if you were to take a rectangle around the head and shoulders top, that whole structure at the top of that, and then bring it right below there, you've basically had a full measured move of that. If you look at just take basically that head, right there, can you put a rectangle? Yeah, that right there. If you were to take that high to low and then put it below the break of that, you've probably had that full measure move. I'm eyeballing that pretty correctly. Yep. And just parallel and put it beneath it or drag it below it, however you want to do it. Yep. You've had a full measure move down, guys. That's considered a full measure move. Remember, markets are geometric in structure. In first grade, you probably learned about your number line, your XY axis. It's just played out for you. The other thing with this that Josh is showing you, if you haven't caught this yet, watch the first retracement to the blue moving average. The first retracement to a new set of moving averages or any indicators, any indicator you think has value, the first retracements really should be your strong opportunities or a recovery of them. So pay attention to that. On top of, there's our beautiful fibs.
Just kind of riffing on some of this stuff here. I don't know how much that COVID bottom is going to impact. It's interesting. We get oops, didn't drop it. Y'all think I'm weird. Scott will think I'm weird the way I draw fibs.
No, I won't. Actually, I don't.
I judge him a little bit in my spirit, if I'm honest. So there's a guy, Scott and I were best friends with him. His name's W.D. Gann. He died in like the 20s, for those that joke fell flat on. He suggested that oftentimes it was the secondary move that was the more accurate measurement. And what he means by that, my interpretation is, here's your primary move, here's your secondary move, here's your tertiary move before we started heading down. Yep. He's saying that these are the ones that often give us the better price points for measuring. And then the reason I picked this little place on there is it's ready to gap. Gaps are your code breaker. They will give you the cipher to put into the Fibonacci machine and spit out genius. So what I see showing up here, and this doesn't necessarily act as a magnet. That's a terribly ugly, inefficient line. Come on back. I'm not advocating that this acts as a magnet of any type, but it is just interesting. If we were to get down to 273, that is a confluence zone there, meaning we've got multiple fibs that are lining up, giving us insights, but also look at how well they have lined up historically too. And we're not going to get into a Fibonacci training here, but I see fibs as graph paper. You can see in light on my background, there's legitimate graph paper that TradingView puts on there. But Fibonacci becomes a dynamic graph paper that as you start to get this framework established, you can move it over to the right and then up or then down geometrically, as Scott says. And I like that phrasing. So I'm going to delete this one because I was just curious. Well, let's look at one more thing. If we've got any, I've gone this far down the rabbit hole. Yeah, there could be so there's so much to look at in here. I mean, I could spend a half hour geeking out on drawing this, but here's how I make it simple. There's a interesting set of targets on Goldman Sachs. So I think what I was curious to see, Scott was talking about this being a measured move, and it is, so there we are. Like this could be the bottom and we go up, but we could also come down to here. We could also come down to here. We could also come all the way down to here. So that just helps give you guys some framework of where, I guess I would see it as like, the old game you played in school where it was like, Simon says stop, Simon says go, and you're trying to catch people off guard. Like, if you're sitting right here, you may not want to be shorting it, but if you're up here, you've at least got some momentum to come down into that box, and you can move your stop up and not close the winning trade for a loss. One of my personal rules. Just gives you some guidance for where to maybe think about entering. What's everybody laughing about on the Zoom side? I see Scott
Nothing.
doing laughing.
Not face. A thing.
Yeah. I see. I see what you did there.
I got y'all go back when you review the video and take screenshots of what he just showed you. There's so much wisdom with what he's showing you guys.
Scott is so good for my self-esteem. Everybody needs a friend in their life like Scott Landers, Stock Landers.
That will never go away. I don't know what you were thinking when you came with, but I love it.
We joke, but I actually am completely serious. Everybody needs a trading buddy, not a trading adversary, but a trading buddy that'll, crack up with you, laugh. Scott teaches me things. I don't really teach him anything, but he's gracious and claims that I share things with him. I wanted to point this out too, because it ain't bragging if you can do it. Y'all seen Deep Sky today? We're 6 for 6 in the intelligent watch list. We'll see how the S&P closes. And Dow obviously was accurate, but I pulled all these up a moment ago. Boeing is over here, forecasted bearish. Oh, it just flipped bullish. We'll see how it ends, but right there we go. Boom. See, you just gotta wait. Now we're bearish. That's how you should always trade. I'm just kidding. Don't wait. Forecasted bearish on PVH, trading bearish. Forecasted bearish on Polte, trading bearish. I mean, we rewrote this dang thing, and it still makes me smile when it's so accurate. And these sky scores are just fantastic. You start getting below 650, and I don't necessarily listen to it as much. But anyway, just thought I'd bring that up since it's our show and we can talk about whatever we want, can't we, Scott?
Exactly. And I want to throw this in. If you guys didn't see the headline, it says Powell says taming inflation absolutely essential, and a 50 basis point hike possible for May. So what do you think the market's trying to do? Price that into their modeling, guys. I just bring this up. He said I just want to make sure we get this in here. It's appropriate in my view to be, and this is him saying, not me, moving a little more quickly to raise interest rates, Powell said, while part of an International Monetary Fund panel. I also think there is something to be said for the front end loading any accommodation one thinks is appropriate. I would say 50 basis points by May. So just, you guys can go read that out there. I know that's out there in the mainstream, but that is influencing. It's going to impact how people are thinking about what's this going to mean for all sorts of areas in the economy, whether it's mortgage rates, whatever the case may be, and just the overall health of the economy. So let that sink in as you're trading today, okay?
Yeah. So 50 basis points is 0.5% is what he's saying, correct? If you guys are curious how all this flows, the 10-year bond is generally what the mortgage rates follow, interest rates as well. So you can kind of keep an eye on this. So interest rates obviously been going up, skyrocketed. This is, I think, the last rate hike. And today's obviously pricing in what that was. The other thing, and I didn't bring it up here, but we will, and I'm gonna have to wrap this up just in a couple minutes because I need to take my daughter to an appointment. We can't do the full hour, but here's the dollar, and just I'm gonna drop this truth bomb out there, and y'all can play with it as you want. The inflation is legit. Like, it's happening. Y'all are paying twice as much for chicken, and gas has gone up 3x since a couple of years ago. But look at the dollar. The DXY, the dollar's been strong on an international platform as well, which is actually good for the US economy. We're able to charge more for things, and the value of our dollar is staying strong against all of the other major world currencies. I believe it's like the Canadian dollar, the euro, the Aussie dollar, any of the what you would call the majors in the Forex world is what this DXY ETF is based off from. So, it was interesting. I was having a conversation with my dad, who's complaining about inflation, as we all do, and saying, "Oh, the value of the dollar is going down," and blah. I was like, "Well, actually, fake news. Value of the dollar is going up," and
Exactly.
that's why I'd be cautious to correlate the current Fox News or CNN news with, oh, the market's going to crash. It's just, you all have to set politics and everything aside and trade the charts you're given, not the charts that you're predicting. Hey, that's good. Can we get that in a t-shirt?
Mm-hmm.
Anyway, interesting. What questions do you guys have in anywhere? Yesterday was 420. Yeah, it was. Don't know.
Josh, I'm gonna show one thing before we get out of here real quick, if that's okay with you.
Yeah, do it. I do need to wrap up in about 4 or 5 minutes.
I'll make this quick. All right, so everybody can see this chart, right? This is 10-year bond, right? This is going back to basically 1790. I don't know if this is like the longest running chart. This is the kind of stuff that fascinates me. I'm going to show you this for a reason, but just bear with me here. Look at the long term. Where if you were to take and divide this in half, where is the long term? Where's the midpoint? Well, you're going from 16 down to basically whatever it is, 2. So where's that going to put you? Roughly around 7. Where are we close to that? Just look at the middle. You can see where 4s have been in the past and all that on that. But it brings up one more thing. Can I bring this into here or not? Really quick. This is all years that I have for the 30-year mortgage. Okay, we're sitting down where? 3s. We've been to what? The 18s. Where do you think the long-term average is? Where do you think the most of the average has historically been? Somewhere around the 8s, or just take it and divide it by 2, and that puts you around 8 3/4. The first home I purchased was 8 3/4 back in the
me too.
90s. So you get it, guys. This will mean revert. Well, what is that going to mean to the overall market and the health of everything else? That's why I surfaced this, because you can look at longer term charts and get these a feeling, because it's still a chart, it's still an XY axis. So, and yes, the Dixie is strong, and which is odd given that commodities are strong, and that brings its own red flags. But I just want you guys to see this. You can go search these. There's different versions out there. Unfortunately, TradeStation doesn't let me go that far back to the 1800s. But anyway, you get a sense of it. So I hope that helps, just shed a little light, and we can touch on more of that later, and we'll go from there.
Yep.
Okay.
Yep. I think that's a great point to end on. I'm going to wrap it up here because I've got the appointment, like I said. So awesome. Thank you guys for participating in the show. We had good viewership on YouTube. If you have anything that you want us to talk about, let us know. We're kind of feeling out this whole YouTube thing, and we've got some interesting things scheduled in our minds, but really what we want to do is provide content that's interesting and valuable to you. So if you have thoughts of what you'd like to hear about, let us know. Thank you to everybody who's here in group coaching. I will be sending you a schedule for the Foundations of Trading classes that are coming up. And with that said, blessings on each and every one of you. I hope you use this information to put fat stacks of cash in your jeans, and you use that money to do some amazing things in this world. Scott, thanks for being here. As always, it's always a joy. I'll let you have the last word and take us on out of here.
Appreciate you guys. Thanks, Josh. Appreciate you. See y'all next week, guys. Y'all have a blessed weekend ahead. Stay safe. Bye.
All right, and we're off on YouTube and